Welcome back. Today is Friday, May 27th. We got about 15 minutes to the close, but most of the data is in for this week, so let's just go ahead and do it. So the S&P 500 managed to snap that 7-week losing streak. We finally got a positive weekly close, and it rose about 6%, so very good week. If we close here, it'll be the best week since the 2020 election. So, was that it? Was that the low, or just a bear market rally? The jury's still kind of out on that. Here we have the Russell 2000, which is kind of a more broader view than the S&P 500 is. And you can see we found support at those 2020, 2018 highs there, key level for it to hold. So that was definitely a victory for the bulls. But as you can see, we're still down 20% from the highs in the Russell 2000, and there's plenty of overhead supply to work through. The next major resistance level for the IWM, the ETF at least, is around 190. That is the January, February, March lows, and it also coincides with the VWAP from the COVID lows. So that's definitely going to be a key one to watch next week. So I want to bring in Steve Straza of All Star Charts to weigh the evidence and share what he's looking at. Steve, how you doing today?
What's up, man?
Not much. So what are you watching? Let's start with this consumer discretionary chart. You scared a lot of people with this one. We used it for chart of the day. I think, was it Tuesday or Wednesday? And it's a scary chart, but I don't think it's just bear porn. I mean, it definitely gives you some food for thought. So why don't you break us through that one?
Yeah, I mean, that wasn't my intention, obviously, but never know how things are going to go on Twitter. What really stood out to me this is a chart we look at every day. But what really stood out when I zoomed out on this chart, looking for some signal during past bear markets, was how early this signal came, right? So what I'm doing in the top pane here is just showing you once that XLY is the consumer discretionary spider. So once that ratio in the top pane entered a bear market, right? So discretionary stocks entering a bear market on a relative basis, that happened before we even put in the peak at the dot-com bubble crash and pretty much at the highs prior to the great financial crisis crash. So that just kind of, to me, was like, wow, this was not only a great signal, but also a very early signal. It's not coming so early this time. And this also, to be clear, doesn't mean the market is going to crash and is due for another 40% downside like it was in maybe those past cases. But it does tell you that you want to see consumer discretionary stocks stop underperforming the way they are. You made a good point when we talked about this chart, though. Why do you think the index is so much lower today than it was during these past cycles?
Because consumer discretionary is probably a bigger weight now. I mean, you have things like Tesla and Amazon in there. It's probably a larger weight now in the S&P 500 than it was in those prior cycles in 2008 and 2000.
Right. Totally. And I think that's the answer, right? It's also discretionary stocks as a sector have kind of become like an index for growth stocks, right? So discretionary has the Teslas and the Amazons and the Netflix. Doesn't even have Netflix anymore. Communications does. But it's almost like a barometer for that growth, that large cap growth trade. It's become a very growthy index, which is why it's been under so much pressure.
Yeah, like I said, some really good food for thought there. And consumer discretionary, they roared back after we shared that chart. I think it's up almost 10% on the week. So definitely a nice strong rebound there
and on an absolute basis. On a relative basis, at the close today, it's no longer in a bear market.
Yeah.
But technically, the signal already went off. Listen, it doesn't have to be the exact same way this time around. This doesn't mean the market's going to crash. But like I said, it does mean you want to kind of pay attention to this ratio. And if you're bullish, you're hoping that it stops falling.
Yeah, I mean, if nothing else, like I said, good food for thought. Yeah. So let's take a look at HYG, right? I mean, that one, a few months ago, that was a good early tip that we could see some weakness at the index level when HYG broke down, high yield bonds. But you saw a big rebound in high yield this week. Why don't you go ahead and walk us through this one?
I thought you had like a fun rate of change statistic for me.
Yes, so it was the best week for HYG in about 2 years. I think April 2020. So that was right as we were coming off the COVID lows. That was the last best week, and we just had another fantastic week. So definitely a bullish sign there.
So let's break it down. Let's talk about why we're even mentioning HYG, right? Because
Sure.
we're talking about credit spreads. HYG is just a high yield bond ETF. And when we chart it over treasury bonds, it basically shows us the inverse of what credit spreads are showing. Credit spreads, you're simply taking the high yield spread and then subtracting out the treasury spread. This way, we're just looking at the prices instead of the yields on these instruments. So when we do that, obviously HYG, the high yield component of that ratio, drives it. It's the higher beta. So when we dig in, beneath the surface and actually look at HYG and IEI individually, it becomes very clear that HYG needs to stop falling for credit spreads to stop rising, right? So if HYG can find a bottom here, and you just mentioned there was a momentum thrust, really, over the trailing 5 days or so. We just wrote about it. You can go read about it on the blog this morning. If HYG can find a bottom, credits probably puts a cap on credit spreads. And under that scenario, we would imagine it takes some pressure off S&P 500. Maybe we start to see a relief rally from the S&P 500. You're already starting to see it towards the end of this week, right?
Yeah, and it's kind of like the major averages. In the major averages, we rebounded to those key former support levels. Same thing on this ratio here. We're kind of at that key level. So it'll be really interesting next week to see whether we get above those former support levels or if we just tag them and then dump, Yep. I think that'll be enough information right there. That's pretty much all you need to know. So this next one, I really love this one. Another really telling chart from kind of a macro perspective. These two have been kind of the wrecking ball of the stock market this year. Yep. You have the dollar and yields, right?
Yep.
Both have been moving higher together, putting pressure on stocks. But, this week we saw them both back off a little bit. Break it down for us.
Listen, we've been waiting for the dollar to roll over and provide some sort of a tailwind for risk assets. Finally seeing it since, over the past 2 or 3 weeks. The dollar peaked early May. We're also seeing yields come off, right? And that the whole thing with yields is, is it okay if yields are rising for cyclical stocks? Sure, great. But the most beat up stocks in the market, the laggards, the weakest areas that really need to stop falling, yields rising probably has a lot to do with the weakness and the drawdowns that they've been enduring since last year now, right? So and by that, I mean the high duration growth stocks, right? Or long duration growth stocks, right? Really, really growthy stuff. So the idea here is that if yields could just cool off a little bit, bonds could catch a bid, maybe growth stocks can find some sort of floor and start rallying, seeing that this week, towards the end of this week. And the same goes for the dollar. Everything's denominated in dollars. As the dollar decreases in value, it puts a bid in risk assets, particularly in international stocks. But it should also be bullish for commodities, and we're seeing that. So I guess the question here is, these are strong primary uptrends running into these walls of resistance, right? How long of a consolidation or correction do we get? Was that it for the dollar? Was that it for yields? Or is this just a little bit of sideways and then, more strength, which would once again be a headwind for risk assets? That's a big question now.
So do you think it's fair to say, as long as they're below those lines in the sand, 103 for the dollar index and 3% for the 10-year yield, as long as they're below those levels, you think that should provide some relief to stocks?
They'll stop being headwinds, right?
True. That's a good way to look at it, I think.
How much of a bid risk assets are going to enjoy from just a bit of, them cooling off here? Probably not much. If these trends actually reverse and you see them start trending lower over intermediate timeframes, then yeah, totally. That's a whole different story.
So you're saying there's a chance.
There's a chance.
All right. So let's move on to crude oil, right? A lot happened in that one. It's been coiling for weeks. Why don't you give us your thoughts on that one?
It should go, right? Everything in this space is working right now. We had the explorers and producers break out to new highs this week. Energy futures or energy commodities continue to work, continue to trend higher. Natural gas is strong. We're seeing all crude oil derivatives remain strong. We're also seeing like refiners and other groups within energy kind of catch a bid and start participating much better, making new highs. So there continues to be a lot to like. Energy seems to be up when the market's down, and then it's also up when the market's up. So that's really the place to be. But like we've talked about on here before, I think if you're very long energy and have a lot of exposure to energy, you want to see other things start working. Because if they don't, and energy is the only area working, you have a target on your back. And I'm not as comfortable today holding energy stocks as I was 6 months ago, or even 3 months ago, when other cyclical trades, commodity stocks were working. We've lost base metals.
Yeah.
In many respects, right? So that doesn't make me feel good. I would like to see other areas of the commodity trade working better. I would feel a lot better about energy.
I think the other interesting point is the strength in energy stocks, right? Like you're already seeing those move. Ian McMillan had a great chart of the ETF crack, which I think is oil refiners, that one breaking out of a nice base. So you're getting that confirmation from the energy stocks. Energy, I think, was the second best performing sector behind discretionary. And it was right up there. I mean, it had a great week. It still rose like 8%. So while you saw some of those other sector trends, like kind of reverse, like discretionary and tech kind of made a comeback this week. Well, energy still continuing strong, right? It's not like that one rolled over when tech and some of those other risk on sectors got a bid. So that's interesting. And would you look at the strength in energy stocks as confirmation that, yeah, this thing probably is going to break out higher?
It's not confirmation, right?
Yeah.
So it's supportive. Yeah, totally. It's all evidence suggests that crude oil should break out here. Sorry.
Little guest appearance from your kitten.
Yeah, she's going to be bad.
So let's end it up with Bitcoin, right? Today we broke to a new 52-week low, or at least we're trading at it now, below that 29,000 level. What are you seeing for it, and Ethereum too, for that matter?
Kind of hung in there today again. The wick pierced through that 29,000 level. I think at this point, like, Bitcoin is the apple. It's been the apple, as you kind of mentioned when we talk about this. But like, I think Ethereum should be a great signal here. Ethereum's right down at those summer lows. It's been weaker. Man, if Ethereum breaks that 1700, called 1720 level, Bitcoin is really the only thing left for crypto bulls. So do you want to make the bet that, everything else in crypto is going to break down, crypto stocks are going to break down, but Bitcoin's going to hold and work? Probably not. It's probably just a matter of time, considering all the other evidence that we have. So when I look at a chart of Bitcoin, sure, it's encouraging that growth stocks bounced, and a lot of those, long duration stocks worked towards the end of this week. But what's not encouraging is that Bitcoin didn't follow, right? And you also have dollar came down, put a nice bid in stocks, Bitcoin, nothing, right? So kind of like, well, what do you need, Bitcoin? I'm not bullish here.
And nice little fun fact from JC today. It's in the midst of a 9-week losing streak. So if we close the week out lower, that'll be the first 9-week losing streak in its history. I mean, it's already broke records. Last week was 8 weeks down, and it's never done that before. So rare air for sure. Steve, I got one. John Roque shared this one earlier, gold versus Bitcoin. We used it for the chart of the day today. And the point there is, gold hasn't been particularly strong lately, but it's breaking out relative to Bitcoin. Right. So, if assets that haven't even been that strong, like gold, are breaking out relative to Bitcoin, definitely raises some question marks there. Yeah.
We used to joke, like, just a few months ago, you could chart anything, denominate anything in yen, and it's going up, right? Mm-hmm. It's getting to the point where you could start to say that about cryptos and Bitcoin, right? Yeah,
like kind of similar to what you were talking about with that HYG IEI chart. Bitcoin's going to be the dominant one here because it's the higher beta one.
Right.
But again, it just speaks to that weakness there. I mean, man, gold is breaking out relative to it. Oof.
And you're right, though, too. And, I wouldn't dismiss this. This is not nothing. It's interesting. But if you look at Bitcoin over gold and then overlay Bitcoin, you almost can't tell the difference. And you get into that with ratio charts a lot, where if you have one that's super high beta in the numerator or something, and then something in the denominator that's very low vol or low beta, right, doesn't move much, the ratio will be driven by the more volatile asset, obviously.
Yeah. Well, Steve, thank you so much for sharing your thoughts and some excellent charts. And we're actually going to be off next week. Believe it or not, I am officiating a wedding. A couple of my best friends are getting married back in upstate New York. So, Steve, can you believe that?
I don't know why. I don't know what they're thinking letting officiate their wedding. That should be fun. I wish I could be like a fly on the wall to watch it, but
well, I'll send you pics and videos for sure.
Well, enjoy.
Well, anyway, have a great weekend, brother.
All right, later.
Thank you guys for watching. Like we said, we're going to be off next week, but be sure to click like and subscribe so you won't miss us next time. Thanks.